Chapter 4: Financial Intermediaries and the Banking System. Learning Objectives. Explain what a financial intermediary is and why so many different types of financial intermediaries exist. Describe the functions financial intermediaries perform. Describe a fractional reserve system. Describes the major characteristics of the U.S. banking system. Explain the function of the Federal Reserve. Explain how banks in the United States differ from banks in other countries. Financial intermediaries are specialized financial firms that facilitate indirect transfer of funds from savers to borrowers by offering saving instruments and borrowing instruments. There are several types of financial intermediaries: commercial banks, credit unions, thrift institutions, also called savings and loans, mutual funds, whole life insurance companies, and pension funds. Central banking, the Federal Reserve System. The Federal Reserve System manages the monetary policy of the country. Decentralized network of regional and district banks, supervised by the Board of Governors, who are appointed by the President. The key concepts and principles in this chapter. What is financial intermediary? Why are there so many different types? An organization that takes deposit and uses the money to generate returns. Individuals or businesses have different needs that require different services and products. What functions do financial intermediaries perform? Primary function is to facilitate the transfer of funds from savers to borrowers. Key financial intermediaries concepts. What is a fractional reserve system? Financial intermediaries do not have to retain 100% of the fund that customers deposit. What are the major characteristics of the U.S. banking system? The U.S. banking system is based on the fractional reserve system. It's a dual banking system. Banks are chartered either at the state level or the federal level. What is the function of the Federal Reserve? The Federal Reserve is to direct the monetary policy of the United States, manage the supply of money by buying and selling government securities, manage existing reserve requirements of financial institutions. How do banks in the United States differ from foreign banks? The U.S. banks are smaller in size and offer fewer services than those in most foreign countries.